This is a special edition of Macro Voices with hedge fund manager Eric Townsend, the premier financial podcast targeting professional finance, high net worth individuals, family offices, and other sophisticated investors. Now, for this special edition of Macro Voices, here's hedge fund manager Eric Townsend.
Macro Voices All-Stars episode 45 was recorded on August 12th, 2019. I'm Eric Townsend. Louis-Vincent Gav joins us once again. Louis, I think we've got to start by talking about Hong Kong. This is a situation that there seems to be quite a lot of different views on. You know, some people would like to say, look at the assembly of troops in Shenzhen. You know, China is getting ready to invade and occupy Hong Kong, and it's going to be the next Tiananmen Square. There's other people that are saying, no, that's nonsense. There's really no big risk. China's just making sure that they have, they've always got troops standing by. It seems like there's definitely been an escalation of the violence and the protests. The Hong Kong airport was closed completely. All flights canceled as a result of what looks like the protesters just occupying the airport. I'm not, frankly, I don't understand what their motive was in doing that or what they would accomplish by that. I've also seen some reports of the triads, which are the organized crime gangs in Hong Kong, are beating up the protesters, and I frankly don't understand the motive for that either. Is the organized crime coming to the defense of the Chinese government? Help us make sense of what's happening in Hong Kong and what does it mean for global financial markets.
So look, we could spend at least an hour on this, if not more. But before I start, I want to congratulate you. I can't believe you're already at episode number 45. That's something you just started a few months ago. That's very impressive. So congrats on that. Secondly, thanks for having me. And indeed, Hong Kong is actually a good place to start. It's reflective of a lot of the tensions that are unfolding. Frankly, not just in Hong Kong, but around the world. Although the situation in Hong Kong is probably made worse than, say, the Gilets jaunes in France or the Brexit vote in Britain, etc., because it's a mishmash of so many things, not least of which one, a great resentment towards China. I think the first thing we have to acknowledge when we look at Hong Kong is that most of the people who live in Hong Kong because they chose to leave China in the 50s and 60s and the 70s and the 80s. They chose to leave China because they profoundly dislike the Chinese Communist Party. They might do so for religious reasons. A lot of people moved to Hong Kong that were deeply Christians because they were being persecuted in China. They might have done so for ideological reasons or simply because to look for a better life for themselves. But whatever the reasons were, Hong Kong is made up of people who, in essence, chose to leave China and who basically regarded the Chinese Communist Party as a non-legitimate government. Not all of them, but a lot of them. And so any attempt by China to impose its way onto Hong Kong meets with great pushback and great anger from the population. And so today, I think that the situation is very tough because what you have in essence, you and I talked about this before, about the China extradition law that the Hong Kong government tried to push, and that led to 2 million people in the streets. And then the fact that 2 million people hit the streets has emboldened, I think, what is probably a few hardcore group of a few thousand people, mostly university students, kids, etc., who are deeply opposed to the Chinese government and especially to the Chinese Communist Party for all it represents. And, these kids are now very emboldened and, to the point where some of them want independence for Hong Kong or whatever else, things that will, of course, never possibly happen. Now, I think part of the anger that you see in Hong Kong reflects, an important shift that actually took place in China. And that is that really from, let's say, 1993, 1994 till about 2012, you had a period of roughly 20 years where it felt like things were improving in China. So if you were sitting in Hong Kong and you didn't like the Chinese Communist Party and you looked at China, you thought, yeah, you know what? Civic rights in China aren't great. Religious rights in China aren't great. It's not the level that we have in the Western world. But by and large, it's going in the right direction. By and large, things are improving. And, so you thought, of course, people in China don't have the same freedoms as we do in Hong Kong, but the path of travel is going in the right direction. So time is on our side, kind of thing. I think the general feeling since Xi Jinping arrived in power in 2012 is that it's actually going the other way, that there's less civic freedoms, less religious freedoms. And as a result, now you get more desperate because time is no longer on your side. It feels as if time is moving against you. And hence the situation that you see in Hong Kong. So, where do we go from here? I think the most likely outcome is still that the government, both in Hong Kong and China, just tries to play for time. That in essence, they try to separate the few hundred or thousand hardcore demonstrators from the rest of the population, a little bit like they did with the Umbrella Revolution, or frankly, like Macron did with the Gilets jaunes. When the Gilets jaunes started in France, they had 70% approval. And then after a few weeks and a few months, people just got tired of the disruptions. And now, obviously, they're just seen as a massive pain in the ass. Excuse my French. I think that as long as you don't have any deaths, that will still remain, that is most likely to remain the government strategy, which puts, a big onus on the police. There's other reasons that's the most likely strategy. And the number one reason is that on October 1st of this year, you'll have the 70th anniversary of the proclamation of the Chinese People's Republic. Now, obviously, China does not want bloodshed, does not want tanks rolling around the streets, does not want a repeat of Tiananmen just before it has this big anniversary party. You also have another key date that investors should keep in mind, and that's the March Taiwanese election. And obviously, sending in troops in Hong Kong to crush students would basically favor the Taiwanese Democratic Party and would basically kill any hopes the KMT, the Nationalist Party, might have had of regaining the presidency. So if you're China today, between the upcoming anniversary, between the negotiations, of course, with the U.S., and between the Taiwanese election, you're most likely to just want to play for time, which basically puts all the onus on the Hong Kong police. One last thought on Hong Kong, though, I would highlight that part of the propaganda in China is that these disruptions in Hong Kong are basically driven by the U.S. and driven by the CIA to destabilize China. Of course, I don't believe that's the case. Just to be clear, I don't believe that's the case, but what I believe doesn't matter. If enough people at the upper echelons of the party believe that, then that makes China's stance in any trade negotiations likely to be much tougher. If really the Chinese policymakers believe that the U.S. is fomenting trouble in Japan, then they think the U.S. is obviously a bad faith actor, and there's really no point in trying to compromise with them. There's really no point in trying to be friends with them because at the back end, they're fomenting trouble in your country. Again, that's not what I believe, but I believe that is what a lot of Chinese policymakers believe.
Let's move on now to a topic that has got a lot of people's attention, which is we've got a huge breakout in gold. A lot of us thought there was going to be a kind of a showdown. It's going to be, is it the breakout in the dollar or the breakout in gold? We kind of got both. Now, the breakout in the dollar has been put on hold by President Trump's tweet about China. But for a while there, we had both breaking out together. So it seems like the long-standing inverse correlation between the dollar and gold has broken down, and gold in particular is super strong here. What do you make of this? Does it have farther to go? Are we overdue for a pullback? How do you see this playing out?
Look, I would look at it a bit differently. You indeed haven't had a breakout in the U.S. dollar. The U.S. dollar, if you look on the DXY basis, you've been 97, 98. The dollar has been the dog that really hasn't barked, or at least not barked very much. What you have seen, the very big move, I would say, of the past 3-4 months is, yes, on the one hand, the surge in gold, and of course, on the other, the surge in bonds. You've had bond yields collapse absolutely almost everywhere around the world, and you've had gold obviously shoot up as well. So much so that, if you have a long bond portfolio today, you're up 16, 17% for the year. If you have a gold portfolio today, just the precious metal, not the miners, you're up 17, 18% for the year. And so, what's interesting to me is, I don't know if you read Taleb's book, Anti-Fragile, but in essence, bonds and gold are the two anti-fragile assets of choice. They're the two assets that do well when everything does badly. If you and I think, okay, the world is ending tomorrow, we'll either decide let's load up in bonds or let's load up in gold. And in the past 4 or 5 months, gold and bonds have been surging higher, outperforming almost everything else, definitely outperforming stocks. So the markets are basically bidding up anti-fragile assets right now. And I think that's an important message in its own right. The message from the market is things are turning south and turning south quickly. Now, in reality, I think this reflects, first and foremost, the fact that global growth is slowing. And global growth is slowing. If you look around the world today, you look at the PMI, the ISM surveys, you have 4 countries that have ISMs over 50: the US, India, Canada, Australia. Everybody else is below 50. Everybody else is decent size. Now, the slowdown in growth, when you think of it, is happening at a time when valuations on bonds, valuations on equities, frankly, valuations on real estate in almost any major markets are basically set between fully priced and outrageously expensive. So we've got a situation where, frankly, most asset prices are very punchily priced, and growth is slowing. Now, there's another quandary in there, is that if you look at the past decade or so, every time growth was slowing, growth reaccelerated thanks to China. In 2009, China did a massive fiscal and monetary policy stimulus. In 2016, again, China, big expansion of balance sheets to get the economy ripping higher again. Today, what we hear from China is, hey, don't count on us. First, we don't want to gear up our balance sheet again for a number of reasons. But secondly, we feel like we've fulfilled our international role, we fulfilled our international duties, and now everybody turns on us and calls us cheats, calls us thieves, and falls on us like a ton of bricks. So in essence, excuse my French, but screw you guys. And that, of course, is the big, big difference to the environment today compared to the environment of the past 20 years. Over the past, or even the past 10 years, if you look at the 2008 crisis, the response of policymakers was, all right, trust is broken in the markets. Let us all get together. We create the G20, and we give people the impression that when there's problems, we'll provide a backstop, and we'll all get together in a room, and we'll help each other out, and we're all in this together kind of feeling. Fast forward to today, and the situation couldn't be more different. Today, you've got the U.S. trying to trip up China. You've got China trying to trip up the U.S. now, very visibly. That was, in essence, the message of Xi Jinping's Long March speech of mid-May. You've got the EU trying to trip up the UK. You've got Boris Johnson trying to trip up the EU. You've got Salvini in Italy trying to trip up the EU as well. So everywhere you care to look, there's hardly, it's not that there isn't coordination. There's active attempts by policymakers to sabotage one another and to try to hurt the country next door. Instead of a feeling of we're all in this together, let's grow this thing, we've moved very much to a zero-sum game mentality where if somebody else does well, that must mean that I'm doing badly. And in this mentality, should we be surprised that anti-fragile assets are starting to soar higher? Perhaps not. Now, of course, we could say, well, there is a limit to how much bonds can soar much higher. That limit may have already been reached in Europe and Japan. I mean, how much more negative can yields go? Of course, yields can still fall further in the U.S. Meanwhile, on gold, I don't think there's much of a limit to how high the gold price can go, at least in the near term. It's not like it's restrained by a yield like bonds are. I mean, gold doesn't yield anything and never has.
Louis, I couldn't agree more that what's going on here is we're seeing a really big bid in these anti-fragile assets, the safety trade assets, which, as you say, is gold and treasury bonds. But if the message is that global growth is slowing and, the shit's about to hit the fan in the economy, what's going on with the S&P 500? It seems like basically until the Trump tweet, the S&P 500 just didn't get the memo. We were pushing back to all-time highs. And it feels to me like the only thing that can bring the S&P down that we've seen in recent months has been President Trump restarting some kind of, fight with China. And it seems like those usually get worked out. And as soon as there's a signal that it is getting worked out, we're back to new all-time highs. How is that possible in an economic situation where all of these anti-fragile assets are catching a bid?
So a couple points here. You're absolutely right on the S&P 500, but if you widen the scope to global equity markets peaked in January 2018. So that's the first point. The second point, I think the Dow is basically at the same level as it was in January 2018. And so, part of the S&P, what makes the S&P unique is, it's compared to other big global benchmarks, is its weight heavy tech components. And that's been, of course, I think one of the big drivers of the divergence between the U.S. and everybody else. The fact and the belief that, if growth is slowing, if interest rates are going to stay low forever, then valuations on individual stocks don't matter so much, and I can pay up to get growth wherever I can find growth. And that's been one of the drivers of the S&P. Having said that, the S&P lately hasn't also been so super strong, and I think there's another factor that we have to consider, which differentiates U.S. equities from almost equities anywhere else, and that's the buyback factor. As interest rates come down in the U.S., you continue to see an inordinate amount of share buybacks, of financial engineering. So, if you look at national profits, at profits recorded by the NIPA, and you look at, these have just been revised lower to the point where, you have to worry about the profitability indeed of U.S. corporates. Meanwhile, you look at S&P 500 earnings, and those still look fine, to the point where the divergence between national profits and S&P 500 profits is, getting close to highs that you usually see at the top of bubbles. Now, and the divergence is driven by what? It's driven, of course, by financial engineering. Financial engineering, which, if interest rates are zero or on their way to zero, what's going to stop companies from buying back their stock? That's where we are. That's where we'll continue to be, maybe for a while. Interestingly, though, it doesn't seem to be enough to keep the U.S. stock market powering to new highs. The Fed cut interest rates, and instead of going up, the market went down. I think that's an important signal right there.
Well, Louis, I can't thank you enough for another fantastic interview. Before we let you go, please tell our listeners where they can follow your work and a little bit more about what you do there at GavCal.
So GavCal, we do several things. First of all, thanks again for having me. But at GavCal, we do several things. We publish macro research for institutional investors, which investors can go to our website, gavcal.com, GAVEKAL, to find out more. We also manage money for institutions, mostly into Asia. And then finally, we have a private wealth management arm based out of Bellevue in Washington. And some of our writings get reproduced there. So retail investors who want to get access to our writing can subscribe to the evergreen GavCal newsletters that are actually free and keep tabs with some of the things we write.
Fantastic. We look forward to getting you back on the program soon for another update. Listeners, be sure to stay tuned to your Macro Voices feed this week. We've still got Professor Steve Keen coming up on All Stars. We've also got Energy Week featuring Dr. Anas Al-Haji, Tracy Schuchart, and Hedge Eye's Joe McMoneagle. And Professor Daniel Lacaille is headlining on the flagship Macro Voices podcast on Thursday night. For the Macro Voices Podcast Network, I'm Eric Townsend.
That concludes this edition of Macro Voices. Be sure to tune in each week to hear feature interviews with the brightest minds in finance and macroeconomics. Please register your free account at macrovoices.com. Once registered, you'll receive our free weekly Research Roundup email containing links to supporting documents from our featured guests and the very best free financial content our volunteer research team could find on the internet each week. You'll also gain access to our free research library. And the more registered users we have, the more we'll be able to recruit high-profile feature interview guests for future programs. So please register your free account today at macrovoices.com if you haven't already. You can subscribe to Macro Voices on iTunes to have Macro Voices automatically delivered to your mobile device each week, free of charge. Macro Voices is presented for informational and entertainment purposes only. The information presented on Macro Voices should not be construed as investment advice. Always consult a licensed investment professional before making investment decisions. The views and opinions expressed on Macro Voices are those of the participants and do not necessarily reflect those of the show's hosts or sponsors. Macro Voices, its producers, sponsors, and hosts, Eric Townsend, shall not be liable for losses resulting from investment decisions based on information or viewpoints presented on Macro Voices.